Hey, everybody. Welcome back to another edition of the Bulletproof Dental Practice podcast. Today, Craig and I are in a feisty mood, and Reese Harper is our guest. Reese has his own podcast, and many of y'all know of him in the airways. I've been a fan of his podcast. Reese, I've listened to a lot of your stuff. And Reese, you basically run a financial firm, an advice firm for dentists, right? So, like you were saying, we got on. You are a fee-based fiduciary.
Yeah, thanks, Peter. I'm a huge fan of you and Craig's banter. I think you guys.
Why does everyone talk about this banter? I want to know more about this. Sorry to interject.
I can probably relate. I relate to it well because I feel like me and my co-host, Sir Ryan Isaac, we just kind of like have a similar vibe. Where
you co-host your podcast with a knight?
I knighted him.
Oh, okay.
I
knight me too. I want to be certain.
No, I asked first.
It was the first show, and I just wanted to knight him, and so that's what we did. And now I think it might be offensive to people that live in England because it's not a formal knighting, but it was what I chose to do in the first episode. So I just think it's important to me that we keep his title going.
But
anyway,
awesome.
So me and him have a similar dynamic where we don't mind, I guess, challenging each other's ideas. We have a lot of fun with it, and we're really just direct and candid and simple speak. I think you guys do a really great job of creating an
what we do the best is make fun of each other, and people get uncomfortable and they think that's your yin and yang. But like I make fun of all my buddies at friends. Like I feel like that's the guy.
Love.
That's the guy code. That's the guy code. If I love you, I'm gonna make you feel horrible about yourself.
That is what banter means, by the way. It's a noun, the playful and friendly exchange of teasing remarks.
Yeah. All right. So that's anyway. Sorry to interject, but everyone always talks about like, hey, I love y'all's banter and y'all's thing, and I'm like, wait, it's just how we are. But anyway,
that's cool.
Glad to have
you. I'm a fee-based fiduciary or financial advisor, and I just wanted to clarify that. In my mind, there's a big difference between fee only and fee-based.
Okay.
Big difference between fiduciary. Yeah, it's okay, but it's just an important word for us.
Well, let's clarify.
So like there's a commission-based broker or financial planner that gets paid when he sells you stuff.
A product.
Yep.
Like whole life insurance.
Yep, like a whole life policy. And
like maybe someone we had on the podcast. I don't know. I'm just saying. I don't know.
Oh, this guy's been duped before.
I'm not going to throw anyone under the bus, but there's a lot of like bad advice out there. And I would say bad financial advice comes from product sales people who get paid commissions. And good advice generally comes from people who get paid for their time or some amount of a fixed fee for their service or an hourly rate. Or I even think a percentage against an investment account, as long as it's not triggered by something that you buy or sell. I'm fine with that. I think there's reasons to charge a fee that way for some clients, but a fee that's transparent, that's disclosed to you in advance of them getting paid, that's very, very important. And then a commission that is not disclosed to you, to me, is like the most unethical way to deliver financial advice.
Hallelujah, Reese. Sorry, hallelujah. I've had a lot of pent-up angst about this, so I love what you just said. Let that sink in for all the listeners, just what you just said.
And the second thing I'd like to say is if your financial advisor is unwilling to do the hard thing and actually get paid for advice through a fee, then he needs to do some soul searching and change his business model, because it's not easy for any of us to operate this way. And it's easier to sell products and get paid a commission. It's more profitable. But it doesn't encourage literacy among financial planners. It just encourages sales behavior, and they learn how to sell things. They never learn the first thing about financial advice. They just learn how to sell, and it's just encouraging people to become dumber as time passes.
And by the way, when you sell that product, you've got the salesperson, the broker in this case, gets an annuity of a return. So like you, for example, if someone, I'm presuming since you're fee-based, if someone works with you for 5 years and year 6 says, Reese, I'm going to take all my money and stick it under my mattress, you don't make any more money. Whereas the person who sold you that product into perpetuity, they can get a commission structure on that, correct?
Yes, I think there's a big difference though between fee-based and fee-only. A lot of people say, and I know I'm parsing words here, but just to clarify, a lot of financial advisors say I'm fee-based, and then people assume that means they're
Fee-only.
Fee-only, and fee-based means you're living in both worlds. You're like, sometimes I'm going to charge you a fee, and sometimes I might get paid on a commission.
And by the way, that's called duly registered. So
yes.
You can be, one thing, my claim to fame is Tony Robbins wrote that book, Unshakable, which is the Financial Freedom Playbook. And Tony is a massive fan of what you just said. And he's beating the drum on anybody who will listen about this disruption that's going on in the financial world that has to be transparent. And there's a massive disintermediation going on globally with all different things. Like people, people are not really keen on any type of kickbacks anymore. But the problem is, and the cryptic thing is, that people can be duly licensed. So you could be a fiduciary, a registered independent advisor, but also have your broker dealer license too. So you could wear both hats. Is that correct, Reese?
Yeah, there's what's called a registered investment advisor, which is this entity that you can own or be employed by that charges fees only. And then there's a broker dealer that you can be affiliated with that gets paid commissions that they pass along to you. And you could have a dual registration where you're a part of a registered investment advisor and you're part of a broker dealer. And depending on the client, you can decide what you want to sell or push or interact with. And I just think that also is really unethical, because it makes the financial advisor have an impossible task, and it makes the client always get put in a tough situation. I'm not saying everyone who's commission-based is bad, and I'm not saying everyone who's fee-based is bad. I'm just saying everyone who's commission-based has a strong conflict of interest, and people who are fee-based have a conflict of interest trying to decide, how much should I sell for commission? How much should I charge in a fee? And the broker dealers are way more profitable than the registered investment advisors. They make a lot more money. So, at the end of the day, what do the financial advisors learn about? Well, whatever the broker dealer wants to teach them when they go to conferences. They tell you about how you can make this trip to Hawaii if you do these 3 things. And they spend a lot of time educating you on financial products, kind of in a way that, to them, they're trying to do it in an objective way that feels like they're not being manipulative, but they know where they make their money. The parent organizations do. And so the financial advisors get continuing education around stuff that's also the most profitable thing to distribute through the broker dealer. So it could be a mutual fund lineup. It could be an annuity lineup. It could be an insurance product or an insurance carrier that they have a special relationship with. It's just messy, folks. So your financial advisor should be a registered investment advisor and an independent fee-only fiduciary and nothing else. And if he is anything,
find out. And in summation, I'm saying, like, find out, because you'll learn the hard way, like I had to recently.
And I did too. And it's the quality of your question. So imagine their dentist colleague saying, are you a fee only? Do you have an RI? Are you a registered independent advisor? That guy who also maintains a broker dealer license, who can sell you commission products, doesn't have to lie and say, yes, I am. So if the dentist asks, are you a registered independent advisor? He could say yes. And the dentist thinks he's clear, but then he goes and sells you a really highly commissioned product because he also has a dual registration. I mean, how is this stuff not illegal?
It's like, it's crazy. It's crazy that it's legal.
And dentists, we always talk about, these talked about this on the last podcast. Dentists are like, it's the worst industry, because we just get preyed upon on this kind of stuff.
Because we're trusting. I mean, how do we feel as dentists when we're like, Mrs. Jones needed a crown number 30, and they're like, I really want to get a second opinion? We're offended because we're recommending what's ethically, morally right. So we just imagine those are the tint of the color of the glasses we look at life through. So we just figure that other people would have the same thing. But it's kind of interesting, because I've been preyed upon this as well. As a part of a large dental practice management company, I was like their poster boy for this company. And this company has an affiliated financial arm as well. And everybody in the financial arm just has tons of whole life insurance, tons of it, all of them. And the funny thing is, the first meeting, you get taken out to the most amazing restaurants and all the wining and dining that happens. When you're dealing with a fiduciary, they can't take you out. It's they can't, if they're going to pay for it. Isn't there a law that binds you to not spend money on a client?
You have very low limits on what you can spend on a client, and it's de minimis. Like you can take people to dinner, but it's capped per client per year.
Okay, so if your broker, CFP, financial planner, whatever they call themselves, because there's literally 100 names for it, if they're taking you to floor seats at the Oakland Warriors and dinner at Nobu on your first meeting because they think you're a really cool guy, there's time to get up some set off some red flags. I think.
No, you paid for those. You just don't know it.
Yeah, exactly.
You're about to.
Well, the funny thing is I got double sold. So I got all this whole life insurance, and I don't want to capitalize it, but I think I want people to hear this story. So I had all this whole life insurance through Guardian, right? And then a very, very affluent friend of mine is like, you've got to meet my broker, my financial planner. So this guy then proceeds to tell me like, oh, you know what? Your policy is not that great. Whole life is awesome, but Guardian is not a great one. New York Mutual or New York Mass Mutual is a better one. So this guy was going to do a 1031 or 1035 exchange. I don't know what you call it. And resell me another whole life policy, resetting the commissions for me.
Yep, that's common. It's sad, man.
So literally, he's like, you got the wrong policy, but we'll take your $200,000 of cash value and we'll move it into Mass Mutual, and it'll be great. And he was so adamant. And the dinner at Nobu, and I really like you. I want to get to know you. And why don't we go? I have 4 seats at the Miami Heat. Why don't we do that? And some like little red flag went off, and I'm like, I'm not that cool. I don't need to be on the first time you meet me, take me out for a $700 or $1,000 night.
Yeah,
and that's got to set off some red flags.
You're smart for acknowledging that, Craig. And I think in the dental industry, if you think about it, like imagine you worked for a DSO. All right, imagine you worked for a big DSO, and that. If this would be like the worst DSO in the world, okay? But this is the equivalent analogy of financial planning industry. Imagine that that if you go and work for this DSO, that amalgam fillings from company like ABC pays you 58% of production, okay? But amalgam fillings from company XYZ only pays 48% of production. Still a pretty aggressive split given like the normal range of what doctors' production should be, but ABC pays, more than XYZ. So, but if you go with composite, you might earn more or less depending on like which dental supply manufacturer you go with. The patient never pays the dentist a fee ever. The dentist just gets paid through the supply companies for procedures. And that's the same with any kind of treatment. And then that was made
illegal, by the way. That was what the drug companies were doing in medicine.
Yeah,
drug dealers made that illegal.
But imagine it gets worse though, because this DSO has a proprietary line.
Right.
They have a proprietary line too, and if you use that line, that's the only line that you get that helps you qualify for your health insurance and an annual trip. So if you do enough of the proprietary line, you get that kind of special treatment plus a bonus and a retirement plan contribution. That's exactly what's happening in the financial services industry. And it's like the customer does not know what he's paying. These splits are all product dependent, and the DSO ultimately determines like how much is getting paid down to the financial planner.
And you're not privy to find out.
And you can't find out because the broker honestly doesn't even really know either, because he's got this convoluted pay stub, and it's like they'll translate it kind of like they do timeshare stuff where it's like points or you get these kind of credits for this kind of a sale, and it's messy. It's going away. I mean, firms like mine, like 9 times out, it's not like if we're in competition, we will never lose to that case because it's like, it's just the worst model in the world.
Yeah, but in full disclosure, Reese, they only need to do 5% of the volume you do.
Yeah.
Because if they get one client to your 15, they're making more money than you are.
Yeah, like let me just I'll give you an example. Like we invest a lot of money for people. We manage hundreds of millions of dollars. And every month, I mean, millions of dollars of cash flow are coming in, okay, like to our firm that we're investing for people. If I were to take that money and shift it towards whole life insurance or annuities, I would like 10x my revenue. Like
forever, though, into perpetuity.
Until people figured it out, and then my business would implode. So, but the difference is right now, like we're building a platform that other financial advisors want to use. I get called once a week right now from another financial planner in another industry saying, the software you've built, the fee-only platform you've built, the service delivery model you're using, I need something because my business is going away and I got to find a way to add value again. Like there's upside in it for doing the right thing, but it takes 10 plus years for it to pay off. And like a normal dentist, you know, you don't get to make money your first year and kill it. And you have to take out some debt. And when I started my business, I had to go borrow 200,000 plus just to like operate and I didn't have any revenue. Like I was a scratch start, you know? And that's just what you have to do when you build a real asset. Like you have to borrow money to start it. No one's going to like give it to you unless you're this broker dealer and they subsidize the fact that these guys are unwilling to be entrepreneurs. They're unwilling to take risk. They just want to go sell one person and get paid $100,000. So the broker dealer fronts the whole commission. They hide it from the client. And then you have a business, you have a guy that can say he owns his own business, but the only person that really paid for that was the client who got hosed. And it's the most bothering thing to me. And it
bothers me so much.
I'm glad we got to take 15 minutes on it,
but by the way, there's like this Facebook chat room. It's by Sunny. It's the dental investment chat on Facebook. I'm seeing that it's probably about 20 insurance brokers. And they just comment. And Samir Puri is a big believer in like this transparency in finances. So he's always chiming in. But we're always trying to comment like, they're like, whole life is actually a really good part of your portfolio. And I was like, hey, are you a dentist? Well, no, but I'm married to one. Are you a broker? Not really. So they're very cryptic and they get to exist in a very fine gray area. And it reminds me of that Upton Sinclair quote. I'm sure you guys know it. It says, it's difficult to get a man to understand something when his salary depends on his not understanding it.
Yeah.
So these people don't go to bed thinking that they're bad people because everybody's doing it. And there's something in the financial world called the suitability standard.
Yeah.
So as long as you're not screwing people, pardon the French, worse than anybody else, it's not really that bad.
Yeah. Well, and the suitability standard, another way that I like to say it, I think it just adds to what you're saying is, as long as they signed off on it in a 50-page legal disclosure that they couldn't understand, then it's suitable. And
everybody's doing it. Everybody's doing it.
Yeah. I mean, I was told that. I started in the commission-based industry. I started my career at Northwestern Mutual thinking I was going to be a financial advisor. I was there from 2003 for almost 2 years, probably a little over 2 years. And it was 2003 to 2005. There was no like talk of fee only and the industry was changing. And it was really hard for me to leave. I only sold term insurance and disability because I couldn't mentally like make sense of whole life ever. And I realized after a couple years that I really wasn't learning anything about money. I just wasn't learning anything about investing. I wasn't learning anything about securities and finance generally. And I mean, the more education you get, formal education in finance, which I'm not the most educated person, but I do have a master's degree in finance and I'm a CFP and I've got a few other credentials. The more you learn about finance, the more you'll realize how crazy that model is. It's just most of the people that are in that model have an undergrad in poli-sci and then they're done, and they just never really learn about money. So anyway, I'm done on my rant. I've definitely offended like 90% of my colleagues.
Well, it's okay. We've been down this path before because we've used me as an example of like what not to do in terms of.
Oh, me more, bro.
I think I have like still currently I'm in the process, Reese, of unraveling, and it's like I think I have like 5 plans.
Well, You're smart, dude. I mean, you're not doing it at age 61 where
That's true.
most people are, so you're getting ahead of the curve.
So let's talk about that for a second. So let's say someone like this leads me into another question that I kind of want to talk to you about is you kind of found money, right? So now where is the best place to invest that money? Is it A, pay down debt, or B, deploy back into my business, or C, look for alternative investment?
Or D, all the above.
Or D, all the above.
This is going to be a generic, a little bit of a generic answer that doesn't apply to everyone, but I think it applies to 90% of people. Okay. Like this applies to 90% of people, which is the first place the money should go is into the practice. The day one, like the first thing that should
I like this guy, Craig.
No, I like Reese the minute we went online. Reese, you're my boy. You're my boy, Blue.
We speak of the okay. So I cut you off, but
that's okay.
Yes.
I really appreciate that. You guys are awfully complimentary, and I don't get this very
no, we
often.
are not.
No, because
we're a hard judge.
I feel your sincerity, your honesty, and your heart. And to go through and do what you do is hard, and it's respectable because there's an easy button for you to push, and it violates your rules and beliefs, and that speaks to me more than anything else. So that's why I just love it.
Thanks, Craig. But I would say the first thing that people need to do is realize that in dentistry, I mean, you have one of the best entrepreneurial opportunities that anyone who went to get a technical degree will ever have, right? I mean, dentistry is a craft. It's a beautiful career. It's one of the best jobs in the country. U.S. News and World Report just ranked it number 1 and number 2, like specialists and GPs, like in all jobs in the country. It's also one of the highest earning jobs. I would say it's the highest earning job on average, even though anesthesia and sometimes surgery makes it up higher on lists. It's because those jobs get W-2s for their entire income, and dentists get most of their income from profits out of the corp or LLC. And those profits never show up on the national income studies. The only thing that the national income studies track are people's salaries. And you guys know as well as anyone that you don't pay your salary. You want your salary as low as possible so that you don't pay as much payroll tax. Right. That's an aside, but like the career of dentistry is like amazing. And the first place.
And a huge barrier. You know, one thing I always talk to dentists about is like, look, we have I agree with everything you just said, but we have a huge barrier to entry, meaning that like anyone can open up a restaurant, a sandwich shop, you know, a clothing store. But really, I mean, yes, there's DSOs and I know we've gotten around that, but really to compete in the dental space, you have to be a dentist.
Yeah, you're right.
So it's a huge
barrier,
preferential advantage and a barrier to entry. And that's why I love when you say kind of put it back in your office. But let's assume that you are good to go. You've got the office of your dreams. You don't have the shag carpet. You've got great equipment. Your team is you've invested fully in your team.
I would say you're defining that by you're at least running a 20% operating margin.
Yep.
Beyond your production. Hopefully a little bit more.
Yep. Okay. So let's say that's going back to my original question. All right. So let's say you're good to go in the practice. Like the practice doesn't need to be invested in and said dentist loves where he is. Yeah. Now where?
At that point, I would say that there's only 4 places your money can go. It can go in building businesses, which is a dental practice. It can go in liquid assets that are either cash or after-tax investments that you can get easy access to. It can go into retirement plans like 401ks, defined benefit plans, and IRAs, or it can go into real estate. So it can go into businesses, liquidity, qualified plans, or real estate. And in my mind, you start with the practice because early on in your career, you have all this. You start with the practice, then you go to liquidity, okay? Then you go to liquid assets. Liquid assets meaning I want you to have at least 6 to 12 months. I would say minimum 6 months in personal living expenses in your checking account. Anything above 6 months should be invested really conservatively up until you have a 12-month reserve total. And then in the practice have 2 months worth of overhead.
Wait, 12-month reserve total. Go into detail. What are you talking about?
So 12-month reserve total, 6 of that could be invested and 6 of it's liquid in cash.
What is the 12-month reserve specifically?
Of personal living expenses. The average dentist, let's say, spends $15,000 a month. I mean, you're going to need, $90,000 worth of liquidity before you're safe personally. Okay. I don't want to see someone say, I've got $20,000 in the bank. I'm good. Because it's to be a serious investor, you have to start taking some risk. And in order to take risk, you have to be liquid. Mm-hmm. Like it's the only way you can like get to the point to where you're willing to take risk with your money. And so for me, liquid investments to me are cash and after-tax investments in anything that is not a business or real estate. Mm-hmm. So it could be a mutual fund. It could be an ETF. That includes whole life insurance, which we just said we don't like. It's not very liquid, but it is accessible at a very low rate of return and a high surrender penalty. It is liquid. Anything that you can get at that's not tied up till age 59. I like investing my after-tax money a little bit more conservatively than my pre-tax money. Okay, so I like municipal bonds. I like municipal bond funds that are specific to the state you live in. I love corporate bonds. I like being able to depend on my liquidity. Like it lets me take risk in my business and it lets me take risk in my 401k and IRAs. I'm not going to touch my 401k and my defined benefit plan, retirement plan contributions until I've got at least that 1 year worth of personal liquidity invested. And then I'll start thinking about retirement plan contributions.
Love that. That's great advice. Greg, let me have one more question on this because it's something me personally I question. So some people, let's just say like a Dave Ramsey kind of advice, right? So bear with me on that. I know it doesn't apply to dentists, but a lot of these talking heads will say debt, pay down debt, pay down debt. And I personally don't agree with that, especially given that most of the debt that we've acquired in our, lifetimes has been pretty cheap interest rates, right? It's been cheap money. So I think it's an arbitrage of opportunity to be able to like I've been advised by my current advisors look, your debt is actually great debt. And I would not pay this down quickly because you can deploy this much better in other environments. So do you ascribe to that? Do you believe in that methodology? Like when would you say that paying down debt is a good idea? Versus
great. That's a great question. And it's one of the more common ones I get is like, do I pay down the debt or do I invest the money? And to me, I came up with this system of like 12 indicators. I got a trademark for it and I'm building software around it right now. These 12 indicators are the things that govern all the advice I would give someone. So if someone came to me and they said, I have a debt to income ratio that's 41%, I would say, I don't care what your interest rate is. Like, we just can't have that much debt relative to your income, or you're going to always feel like life's a drag. It's just going to feel tight, uncomfortable. Vacations are going to be like a drag. If your home mortgage alone, you can qualify for 42% DTI on your house alone. Like if that's where your home mortgage is sitting at relative to your income, like you're never going to make any financial progress. So we either have to sell the house
because your house poor, right? Yeah.
And the same thing is with the practice. Like you might have $800,000 of practice debt that you're trying to amortize over 5 years. If that forces your DTI to be in the like high 50s, like we just can't pay debt down that fast. The indicator I use is I look at on a calendar year basis. Do you have more than 20% of your gross income left over? Like including all of your let's say that's including your savings, that's including your 401k contributions, it's including like money.
Totally discretionary money, you're saying?
Yeah. If 20% or more is completely discretionary after taxes, after debt, after living expenses, then you're probably like at a healthy debt to income ratio. Like you're probably fine there. And anything above 20% savings, maybe anything above 25, you could for sure throw at debt. Like for sure throw that at debt. But if you're not accumulating 20 to 25% liquidity every year, I don't think you've really earned the luxury to reduce your debt on an accelerated basis. We're going to have to like either refinance your debt and stretch out the terms, or we're going to have to use all of our discretionary to eliminate some of the debts so that our cash flow can get in a healthy place.
Right. Is a lot of this based on a cash flow, like a cash flow index?
Yes.
Like, okay.
So your money can only go to 4 places. We talked about those 4 buckets of investments. That's where your assets can build. but your income can only go to savings, spending, debt, and taxes. That's it. So it can only go to one of those 4 places. And the ratio of your income mix, we call it income utilization, like that dictates what you can do. So if your savings rate's 35%, I'm going to be saying like, holy cow, like you're either making like $1.5 million and crushing it and you just have that much left over, or you're like way like cramping your lifestyle and not having any fun. Like
using scrimping on the toilet paper and like literally like coupon cutting it everywhere you go. And
like that, as a savings rate in the high 30s is like either you're killing it and you've gotten to the point to where you're spending like, you're just making so much that your savings rate can naturally get that high, or you're just cutting every lifestyle expense out. And so I like to look at people's income and their asset mix. And the asset question is the one you asked earlier, and that's where should I put the money? I would say it's practice, then liquidity, then it's qualified plans, then real estate.
What about we have a lot of listenership who has student loans. They're early on into their career. What do you think about that? And obviously, I don't even know what it varies by the interest rate. I get that in the secured kind of situation, but. What do you advise on that? Paying that down, not to mention just psychologically liberating, but what do you recommend on paying that down?
Well, if somebody's got 500,000 plus in student loans and they still don't know exactly what they want to do, like, are you going to be an associate? Are you going to own a practice? Where's the location? What type of practice are you going to want to have? Like, it's more important that you get into the right working situation than it is to pay down your student loan debt. I mean, as you guys know, it's like, you just don't make a lot of progress until your practice is really kicking, And
so someone asked me, they're like, what's the fastest way to pay down your student debt? And I said, make a shit ton of money.
Yeah, exactly. I always that's why I say put the money in the practice first, because there's this we call it a lifetime earnings estimate that we make. You just try to look at when you started and what age you are today and how much money you've made since the point you started. And that's how we grade how efficient you got the practice up and running. So like if it took you like 7 years to go from, 300,000 to 600,000 of collections, like you're just killing your opportunity in dentistry. You just need to go be an associate. Okay. Like there's something about your personality that is not really business oriented, right? Yeah. And so it's fine to be an associate. Like there are many days where I wish I was not a business owner.
Heck yeah.
Oh man, trust me, I know it.
And that's a great thing you bring up is I think there's a self-awareness is missing in a lot in dentistry. Like, from everything from sometimes our consultations with patients, lacking some self-awareness to actually just recognizing that like, hey, it's okay to be an associate and be a kick-ass associate. I'll probably make more money, have less worry. Like,
dude, we have associates that are crushing it with
trust me, Pete and I do too. I've got associates making almost $1 million a year.
Yeah, it's like they're a lot of them are contractors, which means that they can like build retirement plans that exclude everyone.
I know they can contribute more than we can.
Yeah, I have clients that are associates that are putting almost $300,000 away tax deductible into a retirement account with no match to anyone.
Yeah, Pete, you and I cannot do that.
We cannot do that.
Hey, I know.
Yeah, and it's now if you've got 10 staff, if you've got 12 staff in 1 to 2 locations and the demographics are right, you might be able to get away that much, but you're still going to have to give away 20 grand. You'll have to give away 22,000. You'll have to give away 10% of the total contribution. Right. But, and a lot of dentists don't even get to that point. They always just do a 401k and they never advance their qualified plan to something that's more efficient. And they'll do like one test with their financial advisor and he'll be like, I don't know, your demographics don't really make sense. And then they'll just quit and not try. But it is an art to get defined benefit plan testing to maximize tax deductions for dentists. Like there's not like a formula that one person has and everyone has the same formula. You go ask 5 actuaries, run a test, here's my census and tell me what I can put away. You're gonna get 5 different answers. And so dentists don't realize that once it gets past the 401k, it's not an exact science that one person will be able to say, this is your outcome of your retirement plan match.
It's funny. I'm glad you're bringing that up, actually, because I think there's this myth that to get to the upper levels of what a dentist could make as an income, you have to be an owner. And that, Craig, has just dispelled that myth. I mean, you've dispelled it. I think that there's somewhat of a, I don't know, like you don't see associates wearing the badge of honor as proudly as I'm an owner with the practice of this top line. You see like I'm an associate kind of thing, like,
Yeah.
You don't see it. And it should be like, I'm a rock star associate, like, and I'm living my life, making I'm kick ass, so
yeah.
I guess what I just want to hear that the tone is, everyone thinks the pathway to this great income and great lifestyle is through ownership. And sometimes it's quite the contrary.
Yeah. Like in my experience, I like to look at net worth growth, just net worth growth total. We have like a dashboard that connects business debt, business valuation, real estate holdings, all their personal and practice checking accounts. We calculate net worth really accurately for all of our clients every day. It gets updated and in our dashboard. And I can tell you that there is a correlation between income and ownership. Like there is a correlation, that owners typically make more. But I will say that that's only because 30% of owners manage their practice really, really, really well, and they kill it. And then 70% of owners like really struggle, like to the point to where it's like, it's probably a wash at whether they should have been an owner or not. Really? And I'm not saying you should not be an owner. I'm just saying the bulk of owners are making, that's why DSOs, like that's why corporate dentistry is like working, because they're literally they're making more money as an associate than they could if they were trying to be an owner.
Well, also let's just take into consideration that to be an owner dentist, if you are working for free, producing dentistry for free, meaning there's no attributable line on your P&L to your salary, it's really hard to go out of business.
Yeah.
You can be a total screw up and not go out of business. You're not.
Yeah, there's no accountability to whether you're making enough to justify it or not. You're just always going to be in business. Like,
is it a job or a business, right? Like so I think that's what you're saying, right, Craig? Like essentially if you back out what you would have made as an associate, sometimes it's less than what an associate would have made as a business owner. And that's, that's a little depressing sometimes when you're on. I mean, hey, I've been in that situation in times.
Oh yeah. Depending on the cycle of your business, we're all in that situation.
Right.
Yeah. You as a business owner, you have to pass through that moment when you're like, I'm making less than I could as an associate. Like you have to pass through that point because your first associate hire, if you're smart, will cut your income. Like it will make you make less 100%. Money. You can't make more when you hire that first person.
Yes.
Growth.
Thank God you're saying this stuff. This is important.
But also growth cycle. So you open up another office or redo your office, you will make less again than your associate.
Yeah.
So like if you want to do it, like you have one or two associates, you want to dream to build a bigger facility, you want to triple the size of your facility, you're going to go through a couple of years where you're making less than your
less money. That's another myth. I've got that literally hiring an associate, you'll quote unquote make more money. No, you'll actually take a pay cut for a little while.
Yeah.
Now you're
from a successful standpoint.
You're exactly right. But your personal wealth will go up.
Right.
And it's because the value of the asset that you're building will increase. So you're not getting the cash flow, but this asset gets bigger. But that asset is not guaranteed to
guaranteed. And you're holding the bag. If the economy fails, like you're the one holding the bag.
Yeah. And
we talk about this all the time, man. All the time we talk about it.
The thing that I think is most insightful is to look at where you go. If you let's say you go past this 2 to 4 location and you're really going to be this like 20 to 30 location DSO. At some point, you will be given a salary, in exchange for stock in the enterprise. You don't even get to work on production at some point. Like it's now you go from making 7 figures to where you get to make 250 again, and it's a fixed income. But you get all of this, you get this asset, this unrealized.
You mean in a liquidity event and selling your company, you're saying, right?
Well, in a lot of cases, you will have to give up you'll still have ownership, obviously, of a large portion, but if you have a liquidity event, it'll come at the cost of a salary or some kind of reduction in your pay to put you in a management position
for them to pay for that asset they gave you.
For them to pay for the asset that they gave you.
There's no winning.
Now, no, there is a huge win. Okay. But it is a lot harder. And I've been through this like personally, and I've had to give up my production-based pay in exchange for giving up ownership in my asset to investors who provide me with a lot of liquidity and a lot of growth capital. And I know how it feels like, and it's a hard decision. It's multiple years of thinking about that. But it does pay off. Like you get a capital gains transaction that gives you a lot of liquidity. It's life-changing money. I mean, if you get $1 million handed to you after taxes when you're in your 30s, that's worth so much more than if you're in your 60s and they hand that money to you. When you're in your 60s, it's like my life, like the most like eventful, opportunistic part of my life has passed, right? I mean, I'm just saying $1 in my 30s to me, I value much more than $1 in my 60s, just from a lifestyle perspective. Like I need the money now so I can experience life the way I want to, as opposed to when I'm 70.
What is that called? What you're describing? Like,
Time value of money.
Yeah, time.
Well, time value of money. I just want to be clear. Time value of money to me is the money grows and becomes worth less over time. I'm just saying like $5 today when I'm making $100,000 means a lot more to me than $5 will mean when I'm 10 years from now when I'm like making more and my life is better and I have more wealth. It's just that I care less about money the older I get because the demands on my spending are less. And so I'm just saying it's worth it. It's totally worth it. I don't want to discourage anyone, but it's also like, it's not as, you work way more hours. It's much less attractive than people think. The agony, the pain, the stress of growing an enterprise. Like there are many times where you just wish you weren't doing it. You question whether it's valuable, whether it's all been worth all the effort. And I just think it's important to know that as an associate, like, and as an owner, that it's something bigger that's got to drive you to push through that. And it's not really the money that's driving you. It's like, you just want to take your ideas and see them come to fruition.
Yeah, it's vision.
That drives you more than the money. And if that isn't something that's motivating to you, and you literally are like motivated at the idea of like, I could be at 33 or 35% of production instead of 30, and you're doing a financial analysis on your income that makes you like feel motivated to get a little higher percentage of production, in my opinion, you should just be, you should be an associate if that's really motivating to you, because the things that drive owners, like, they're not always financial. So
that literally gave me, you need a big megaphone, my friend. I mean, honestly, that gave me kind of chills because you're right. It's not, if building an empire or big office or whatever, if you're only driven by money and not the purpose, I know this sounds a little woo woo, but like, that is not sustainable and you will wear out. And
that was my vision, Peter. I said, like, I consciously said to myself, would I rather express my vision and make less money? Or money was not the main motivator by any stretch. It was never the main motivator for me. And I think that it's really important to know thyself, as Shakespeare
self-awareness thing we're talking about, right?
You got to be aware. You got to know and there's so many traps that are specific and endemic to dentistry that I think bear some mention. We have this problem in that any bank will give us like 110% financing on anything. We also tend to do better every year. So what's the ADA statistic about what percentage of dentists can retire at 65? It's like,
well, the average dentist is 69 right now. That's the average age.
But I find myself, like, even though I know this, viscerally, I find myself making decisions that are not consistent with these statistics because I'm spending more every year. And if you make more every year, but you're making, let's say, 5 or 10% more every year, but you're spending 11 or 16% more per year, that's a problem.
Yeah.
And like, look at Warren Buffett driving the same car. Look at how dentists we spend so much as a profession.
Well, I think it's how you earn it, Craig. Like, most people get quarterly bonuses and a lower salary, or they get some kind of like annual bonus and a lower salary. I mean, dentists really do have the same amount of income almost every month, and that's pretty unusual.
But I think it's also a good problem because what's the statistic on retirement to death in dentistry?
Yeah.
What?
It's like 11 months. Someone told me that, like, I need to, that's a little bit of a.
That's a research project.
I know. I was gonna say I need to back that up with some data, but I literally remember hearing that in someone.
That's not uncommon though outside of dentistry.
Yeah, like you
outside of dentistry, there's a high correlation to death and retirement, and it.
Yeah.
And
so why retire from something like?
Well, here's the problem. Like, we got to stop talking about retirement. Like,
exactly. That's what my point.
The idea, right, is, and what you're saying, Peter, is like what I do is I have the statistic we measure called total term, and it just tells me if work is optional for someone yet. Like, when does work become optional for someone? That's what total term tells me. Mm-hmm. And it's basically like you have to have a net worth that's about 30 times your annual spending. At the point you have a net worth that's 30 times your annual spending, then mathematically you are independently wealthy. Like, you're financially independent.
Nice.
Okay. And so that's if you're at 20 times your annual spending, you're probably you're not financially independent in any circumstance, unless you're like 80. You know, I mean, you have to, the earlier you want financial independence to occur, the closer you need to be to that 30 multiple. And there's a lot of math behind it. But like, when work is optional, you can keep working. Like, it's fun to work when work is optional. Dentistry is a lot more fun when you don't have to produce it.
Yeah.
And I just say the motivation for me to get financially independent at an early age is like, at least this has been my experience. The more liquid I get, and the more my business grows, and the more my net worth increases, the less stress I feel at work. Yeah. I just don't care anymore.
And the more like freedom you have.
Yeah, and you got to get money out of that asset though to feel that way. Mm-hmm. That's why associates can feel so good, is most of them have more liquidity than the owners do. 100%. And so you have to harvest the asset along the way in order for you to really feel like you're making financial progress, because you'll crash in your 50s. I mean, it's just like you build this asset, and if you never harvest it and you never get liquid, you can't take 4 decent vacations a year and like just have some flexibility. I mean, it's just too big of a grind. And so that's why, like, I don't like obsessing over debt reduction, because debt reduction does not help me feel financially independent. It just makes me feel like I've got less debt. And those are very different to me. Liquidity gives me financial freedom, and debt just makes me feel like I'm having less debt. Like, if I take $100,000 and put it in an investment account and grow it at 5% a year, but I could have access to it at any time. I could borrow against it and avoid capital gains tax. I could just watch it grow. I can earn the interest, or I could take that same $100,000 and pay off an $800,000 loan down to $700,000. I feel like zero financial like relief from paying down the debt, but I have a massive financial relief from the liquidity. Well, a lot of people are that way. They just don't.
Let's just talk about that debt. So if you have, debt on your practice and it's at, let's say, 4%, what's the effective cost of that debt?
It's probably like 2.5,
yeah.
2.6.
Exactly. And, the payment is fixed. So the time, getting to the proper term, the time value of money, that same $5,000 a month payment in 10 years is far less.
That's what I'm saying. It's the biggest arbitrage of our career.
Right.
Yeah.
So I know
like,
that
businesses don't, if you've got a business, you don't just try to pay down the debt like as your first goal. Like, no business does that. If anything, they continue to lever the business. And that's not necessarily a good thing. I mean, Bear Stearns, Lehman Brothers, Wachovia, like, there's a lot of problems that come from that. But in a small business environment, you just have to look at, like, are you trying to build a $10 million practice? Are you trying to build an 8, a 6, a 5? Like, if you spend $100,000 a year, or let's say you spend $10,000 a month, you don't need more than $4 to $5 million to be financially independent. So we only need an asset. Like, we don't need to build an asset that's worth more than $4 or $5 million. If you don't want to, like I found, at least for me, like, everyone has to get to a point where they say, like, you start with like what you spend. Say, like, I spend $20,000 a month. That's my number. Like, I need that to feel like life is good. Or I'm at 15. or I spend 25 a month. I got clients that spend $100,000 a month, and that's crazy to me. But like, that's their definition of like normal lifestyle. And they just have 3 country club memberships, 5 houses, and they do a ton of travel. And they're way more successful financially than I am, you know?
Right.
That's what they're driven like more to hit a certain number.
Yeah, it's a scorecard for them.
Right? Yeah. But most of us are like working past our number. Like we don't know what our number is because we don't track our spending. And you can't just like cut your spending arbitrarily. Like it's like diet. It's like anything that's like systemic to you. Like you spend the way you spend, Peter, because that's like how you like to live, right?
Right.
And I'm not going to change it just because we're like, got to cut back. It's like, dude, but I just don't eat at Sizzler. Like I like this kind of steak. And some people are like, I love Sizzler. And like, well, the guy that loves Sizzler that is different than me. And so he doesn't need as much on a monthly basis. But one guy needs 3 million, one guy needs 4 million, one guy needs 5 million, one guy needs 6. But we typically either under accumulate or we over accumulate, but we're rarely accumulating to the right number.
Because money's an emotional thing. It's not logical. And there's a book, which I got some of the cliff notes on. It's like, you don't trump the money game. You don't win money. You don't win the money game. Money, you know, you can do whatever for many people who are, you know, there's a difference between achieving to be happy and happily achieving. My dad told me at 65 that at 68, he's going to retire. So knock on wood, he's 77, he's working. And, you know, that statistic you said about death and retirement is a broken industrial age concept that has no place in modern world. It was designed by the German chancellor at the turn of the century because the workforce was getting too expensive because there was too many senior people. So they instituted a government policy to force people into retirement so they could pay lower wage younger people. Yeah. But so this whole idea that we're going to ultimately be free, and the freedom is in the fact that as long as you're loving what you do and you're not oppressed by it, that is freedom.
Yeah.
And for those that are listening that make $100,000 a year or have 300 grand saved up, guess what? You can retire too. You just might have to move to Phuket or Vietnam, but you can retire.
You can, yeah. You have to have your spending be your wealth has to be a 30 multiple of your spending. So you got to adjust your spending back.
Right. So it's just like, what do you want out of life and what are your rules and beliefs? And you can actually retire. Even if you have 300 grand, you can retire.
Yeah.
You just have to move
you're hitting something that's important to me. I just want to, I know we're running out of time today, but if people could remember like one thing that I think dentists don't end up doing is I don't think they invest their liquid assets aggressively enough. Okay. I don't think that the average dentist they're too conservative with their liquid assets. And that costs them millions of dollars over a 25-year career. My point is, if you're not going to invest in building a big DSO, if you're not going to have multiple locations and you're just going to be a 1 to 2 to 3 location doctor, you need to get really serious about how you're going to invest your liquidity, because that's going to be the variable in whether you can make work optional at an early age. Because you can't just sit on your cash. You can't just like hope that 4% is enough. Like liquid investment accounts, like just the average, like academic average, there's a Nobel Prize won on this called the 3-factor model. All right. The 3-factor model was designed by a guy named Eugene Fama of the University of Chicago, Kenneth French from Dartmouth. And basically what they decided was that investments grow like more than the average because of 3 things. They're either really small companies, or they're Warren Buffett type companies that are what are called high book to value, book to market. They're value stocks. So value companies grow more than growth companies. Like Facebook is not as good of an investment long term as like Blockbuster Video, for example. I'm giving you 2 big extremes. Like if you buy a bunch of Blockbuster videos that you know are like about to go away because they're an imploding business model, those will have a higher return over 10 years than 100 Facebooks will, if you just average them all together. Not like not comparing Facebook and Blockbuster, but saying those types of companies. So the small companies do better than the big ones. The value ones do better than the growth ones. And the high quality and profitable companies do better than the ones that don't have profitability. Those, if you were just to concentrate your portfolio in that kind of an index and just say, look, I know that there's going to be a lot of up and down movement, but that is going to like that index, an index constructed that way of like all of the stocks in the whole world that match that criteria, not picking any one, just those criteria. That Nobel Prize, what it was trying to prove was that these are multiple percentage points of additional return, but they come with volatility. Like they come with more up and down movement. But most dentists, like, they have these portfolios that are like mixes between stocks and bonds, right? It's like, I got these bonds, I got my stocks, and together when I combine them, it makes me feel like it's safer. But really inside of that account, there's just aggressive stuff that grows a lot, and there's stuff that doesn't grow a lot. And by mixing them together, it's not like making it better. It's just hiding the truth from you. And the truth is, like, you have some safe stuff and you have some growthy stuff. So you need to have enough safe stuff to feel confident that you can take risk. But like a person who aggressively invests their liquid capital, I mean, they're going to have a 3 to 4 to 5 percentage point additional lifetime return over someone who's more conservative. And that's your opportunity for most average dentists. Like, you can have millions of dollars if you can just stomach the volatility that naturally will be there in the marketplace. You can't time the market. You can't get in and out of it. There's no way to predict the future, but you can have enough liquidity to where you're like, hey, I've got $1 million here. I don't care if it drops to 600, because I know if I had 10 practices, there's a chance they could go down 30% in collections too. Like, that's just the nature of business ownership. That's just the nature of owning equity. And I feel like by committing to a more academic, a slightly more aggressive investment policy than you would do on your own, your financial advisor is really doing you a favor if he can help you stick with that. And he'll know when he's pushed you too far and when he's not, giving you your fear like enough credibility or enough voice. But I just feel like most dentists miss out on $2 million plus in returns that they could have gotten because they're too timid when it comes to liquid investments in the market. And the market's a more predictable return for liquidity than paying down debt. It's a more predictable return than letting it sit in cash, paying off your own house. I don't want to say that to encourage people to go and just like do this without any professional, like fee only financial advisor talk. You just at least have someone that you can talk to a Craig, talk to a Peter, someone else who maybe is into this stuff, and go, am I thinking the right way? But I'm worried that like dentists, they're not taking the risk of like going and building a big enterprise in most cases. So they're building this liquidity, but then they're also really not investing it in a way that gets them a good return because they're so worried about it going down. Like any business would always only go up, So I'll let you guys ask a question or two about that.
Well, I got something.
We got to wrap, but because we're getting to the point.
Oh, we got to go.
Yeah, well, Pete, I don't know if you feel the same way about Reese. This has been so amazing. I would love to do a part 2.
And we've never, by the way, Reese, that's never been said on this podcast.
You're our first part 2.
Well, that's a huge honor. I appreciate it, guys.
But I love what you said, by the way. There's a couple takeaways that I just heard, and it's really important. I want to reiterate these market gurus. If your CFP financial advisor is telling you, hey, we've had 8 years of a bull market, I want to put you in cash right now because we're due for a correction, like he's some sort of freaking Houdini.
Doesn't know.
Run from that guy.
Yeah.
So when your CFP or market advisor is telling you, we're going to like put our money on the sidelines right now, that goes against all conventional logic. You cannot time the market.
Mm-hmm.
But if you want to go into the market, the best time is today. Always. Even if you invested the day before the largest crashes ever.
You were still using good logic when you did that. And I respect the person that uses that logic as opposed to the person that thinks that they were a hero or a genius for missing out on some crash. Like, they're not being honest, and statistically the market goes up on average like 3 out of 4 days. So like You just have to be exposed to that and
but even if you bought, I remember hearing something from a well-known financial guy. He's like, even if you bought the day before the 4 worst crashes and left it in there over 15 years, you're up significantly more than if you entered it random at any point.
Yeah.
Later on. So you got to get in. But just to quantify your comment that most dentists are too conservative, what are the conservative dentist, what is his annualized return over the last 10 years that you think he left money on the table? So give me a number. You're saying that he didn't beat the S&P on average?
He well underperformed the S&P.
So it would have been better off to just dump everything in an index fund, an ETF, and leave it alone than do what he did.
Well, and I would say the S&P is not the definition of what I was saying would be aggressive enough, but the S&P is all stocks. It's just the 500 largest in the U.S. It doesn't capitalize on those 3 factors I was talking about earlier. Capitalize on those 3 factors would increase your return by several percentage points, maybe as high as 13%, depending on what the actual next 20 years look like. I mean, we just know that these attributes of stocks are the reasons that they're the most volatile attributes. The smaller companies always grow more than the big ones. The cheap stocks always grow more than the expensive ones. That's the value in growth. And then ones that are profitable, that's always a better sign long-term than ones that are never driving a profit. And so, anyway,
so just
give it 4 to 5 points.
Just
4
to
to 5% minimum.
Just to quantify it, you're saying that doctors, mostly the portfolios that you see that you think people are leaving money on the table, they're underperforming even the S&P.
Oh, by 4.5% to 5% a year.
Yeah. Wow. And by the way, Warren Buffett does have that bet that was conclusive over 10 years. He challenged like the top hedge fund managers, these iconic investors, just to beat the S&P over 10 years, and no one could do it.
It's really, really, really hard. I would say that there's a place for those iconic investors. It's just not in the retail market where we're investing $5,000 a month.
Right.
Those investors are trying to get return patterns that are more stable or more narrow or tighter. They're just trying to do something different with their money, typically for a pension fund or some giant like school district or something. They have different goals than a retail person. So indexing is always a better approach for a retail individual. The more sophisticated you get, like if you have more than $10 million, maybe even more than 7 or 8, I'd say there's a place for some of these other things. We won't talk about alternatives today because we don't have time, but there's a place for alternative investing, private equity, venture capital, but it does not apply until you have that 30 TT score we talked about. The day that you're there, there's plenty of conversation to talk about what's next.
Cool. Well, I mean, on part 2, if I have my wish list, I want to jump into the alternative forms, the defined benefit stuff. I'd love to talk about that stuff. I'd love to talk about what are the biggest mistakes that dentists make that delay retirement, because I'd love to have that.
Cool.
And then the habits of the wealthiest dentists. I'd like to get into behavioral stuff, the behavior, because we talked to mechanics.
Yeah.
Mechanics are leaving, but if there's behavioral stuff that we can identify with and see what are the pitfalls, I think that would be really, really valuable.
I agree with that, actually, those 3.
Thanks, Peter. Thanks, Craig.
Yeah, man, that was awesome, man. Honestly, I came in not knowing, we've never talked before, and I came in not knowing you have a great reputation in the industry, but man, that was all ears, and that was you just delivered massive value for the listenership. So I'm really excited. Let's get number 2 on the books and continue this, man. That was awesome.
Look forward to it. I'm gonna have to have you guys on my show here in the next few months too. I'd love to do an in-person though. We can go on a little mountain biking tour, and I'll get you up on a mountain bike for the first time. All right.
Wait.
I'll take you up on that for sure. Salt Lake City.
Yeah. Yeah. So we'll go out to Park City.
I'll be out in Salt Lake. I'll be out in Salt Lake. I'm going to do a Ford Raptor off-road adventure.
You are?
Wait, yeah. Pete, I want to do that too. Can you get me invited to that? Because I got a Raptor.
I'm not your assistant. Sorry. You do that.
No, I'm not asking you to physically do it, but can't you talk to your powers that
be? Hey, you can't delegate to me, just FYI.
No, I'm asking for a favor, you jackass. I'm not saying delegate. Like, give me coffee.
I kind of would like to go solo on this one, Craig, for once. I'm just kidding. But anyway, I'll be out there in July for that, Reese. So maybe I'll hit you up and we'll go.
Right on.
Take me mountain biking. Maybe I'll let Craig partake.
I'm coming too, man. I got a Raptor
trip. All right. Anyway, that was awesome. Reese, again, thanks for your time, buddy. And everybody, thanks for tuning in to another edition of the Bulletproof Dental Practice Podcast.